Everyone, welcome back to Capital Consumption Theory. Today we're talking about money demand and type 2 inflation. And I'm here with Brian Winters.
You say type 2 inflation. What are the two types? Or are there more
So
than two?
the two types of inflation are capacity constraint inflation, and type 2 inflation is a different type. I would actually say from CCT view, it is the opposite type. So capacity constraint inflation is where you have too much consumption chasing too little capital. And the capital, remember, is the productive resources. So when you have too much consumption demand and not enough productive resources, you get capacity constraint inflation. Like the economy is not able to make as much as demand is trying to get, and it causes prices to go up. That's capacity constraint. That's type 1. And then type 2 is the opposite. You have too much capital and sort of too much productive resources, not enough demand. And what happens is that when firms are going and looking at investing into more capacity, they find that it would not be profitable to do that. It would not be a good return. And so they can't do that because there's not enough demand. And as a result, you get interest rates going down, you get capital backing up as financial capital, you get asset bubbles. That's because there's too much capital and it cannot be crystallized into real capital like factories and capacity to serve the consumer, because the consumer does not have enough money to buy the stuff.
Okay, so type 1 is capacity constraint. Type 2 is asset bubble fueled inflation.
Yeah, something like that.
Okay, sounds good. Let's talk.
Yeah. I don't want to say hyperinflation because it's a little bit of a loaded term, but we are talking about the type of inflation that hit Weimar Germany, that hit Zimbabwe, and that is somewhat common a little bit in South America, Argentina, places like that.
And what's the definition of hyperinflation?
So the
It's
definition of
50% per month.
hyperinflation is 50% per month, but
Okay.
we're going to ignore that because that is not the definition of type 2 inflation. And hyperinflation, when you define it that way, you're just looking at the most extreme cases, but you're not really isolating what the dynamic of it is. And so, I think that you should understand an inflationary process by the dynamic that drives it. So to me, type 2 inflation does not have to be hyperinflation. It can actually be non-hyperinflation, but it's all the same dynamic, which is that you have basically too much capital and too little consumption, and that causes problems. So to build a foundation for this, I want to talk about money demand first. Money is an interesting thing, and I think it needs to be talked about more when we're thinking about economics. I think the economics field needs to think about money more. And it is different from many things because supply and demand for money is different than supply and demand for goods and services. So the classic Econ 101, the mental model that everybody has in their head for supply and demand is goods and services. So you have a certain amount of goods being produced or the potential for it to be produced, and that is the supply. And then you have the demand, on the other hand, people who want this good or service and like how much they're willing to pay for it. So there's a few people that are willing to pay a lot, and there's relatively more people who are willing to pay a little bit. And that's your classic idea of a supply demand. But demand and supply for money is different because it is not this flow of constant creation and consumption like you have with goods. Like, it's produced and then someone uses it. And then, if it's an ice cream cone, then tomorrow they may want another one and you have to produce another one. Money um, is much less created and destroyed. It is a little bit through monetary policy with the Fed, but like relative to the transactions happening, most transactions are one where money's not created or destroyed. It just passes from one hand to the other. So if you think about it, money demand is sort of like a very broad demand for some type of savings, even if the savings is only for like, say, 3 days. So you're going to get your paycheck on Friday, but you're tired, you want to go home and have a rest. So you're not going to spend it the very moment you get it. You're going to hold it for a few days, hopefully last for a week, 2 weeks. And then later you're going to spend it and hand it over to someone else. Does that make sense?
Sure.
Yeah, so it's a savings vehicle of some type, and so it's like it puts a bridge between you selling something like your labor, or if we're talking about an earlier economy, maybe you just sold your crops or livestock or something, but you don't want to necessarily immediately turn that into something else that you want. So you turn it into money, whatever that money is. It could be gold. Now it's fiat. It could be other things. And then you're going to hold that for a while until you're ready to get what you want, and then you turn it over to someone else. So you've got this money. So if you imagine the money, the participants in the economy, like this circle of people, the money is being passed back and forth, a little bit like a potato in the hot potato game. But usually this is a healthy thing because the money is just being passed back and forth, and every time it gets passed back and forth, what happens is that somebody provides something to somebody else. It could be a service, could be a product, but people are basically helping each other as the money gets, passed back and forth. But we want to get some sort of scientific understanding and analysis of what to expect with the behavior of the money. And so to do that, if you think about it, it goes back to money demand. So the person holding the potato, and there may be more than one potato, they're going to hold it for a certain amount of time, and the money demand is actually it's units of time, if that makes sense.
The money demand is units of time.
Yeah.
No,
Yeah.
I'm not following.
Yeah. Yeah. I'm not explaining it super well. So it goes back to the equation of exchange, MV equals PQ, MV equals PQ. And then one thing that you can do is you can look at V. So V is equal to PQ over M. And let's just, for the moment, assume stable prices. Say P is constant, we don't have to worry about it. So V is equal to MV equals PQ. V is equal to Q over M. So the velocity of money is like how much production you're getting over divided by the money supply. Does that make sense?
Yes.
Right. That's the velocity. So, right. So you have a fixed money supply, it's circulating, and the faster it circulates, the more production you get. Yeah. So,
Yes.
so that is money velocity. V is equal to Q over M. If you take the inverse of that, the inverse of money velocity, that is money demand. So the velocity is like, say, turnovers. The velocity is like maybe it's once per year or twice per year, right? So if you had so in the U.S. economy, if you look at base money supply, well, usually they use broad money supply. But anyways, the velocity is it's a rate. It's sort of like miles per hour, and hour is in the denominator. It's how many miles you go in 1 hour. Velocity is how many times the money got turned over to somebody else, the turnover times in a particular period of time. Does that make sense? So
Yes.
usually it's denominated in years. So usually it's like 2 turnovers per year or 1 turnover per year. That means that if you have a 20 trillion money supply and you do 20 trillion of production in the economy with it, then that is, once per year. If it's only a 10 trillion money supply and you still do 20 trillion production with it, then you have turned over the money 2 times per year. That money in 1 year, on average, the whole thing went from, one person to somebody else and then to somebody else again, so that you got 20 trillion of production, out of 10 trillion of money supply.
I'm just curious, when you say 20 trillion of production or something, is that the same as gross national product
Yeah,
or
more or
similar
less.
or more or less?
There are little details, like GNP is different from GDP,
Right.
but we're not worried about those details. Like, just production, is fine enough for us. Yeah. So the velocity is a rate. So it is a, something over a unit of time, like per year. And then if you take the inverse of it, then the time is on the top side of the fraction. So now, like, so for example, if you had um, velocity of 2, and you're doing 20 trillion of production on 10 trillion of money supply, and then you take the inverse, then what you have is 1/2. And that 1/2 is that the money demand in our example is half a year. That's the money
Okay.
demand, right?
Yeah.
So
When you
half a
say
year,
inverse, that's the same as reciprocal.
yes, I believe
Okay.
inverse is the same thing as reciprocal.
Okay.
Yeah. Yeah. So what that means is that, with your 20 trillion in production, the money demand is 1/2, and it's 1/2 of that production. So what it's saying is that the whole economy is doing 20 trillion in production with this money, circulating around. But there is a demand. So if it were a barter economy and there's no money in existence, then that would be like zero money demand. Like money doesn't exist and people don't know that they want it or need it. And they manage to just barter this 20 trillion, then it's zero. Okay. But what we actually have, we do have money. And in our hypothetical example, it is 1/2. So that 1/2 is 1/2 of 20 trillion. What it means is that people want to be holding this money for a little bit of time, right? They want some savings. Like, to some degree, it means that because you're selling and buying things in the economy, right? But there's some uncertainty. Maybe you're scared that it's possible that you might lose your job. So if you were like completely carefree, go lucky, and said, it's okay, like, I'll figure something out, then you could have like a money demand of zero and say, I'm not worried. I don't want to save. The very second money comes in my hand, I will immediately spend it. That would be zero money demand. But a higher
And so
money
zero
demand.
money demand is essentially infinite money velocity.
Yeah. Yeah. And infinite is hard to think about, but if you thought about like that, sort of take a little bit back but still extreme, like if everyone was super happy-go-lucky and they were not worried about anything, and the moment money came in, they would immediately be like, okay, I'm gonna go buy something, and every single person would did that, yeah, then the money would be just flying around like crazy, and you could run a really big economy on relatively little money supply. Does that make sense?
I mean, yes and no. I mean, if there's 5 of us sitting around in a room and we just pass a $10 bill around as quickly as we can, we're
Yeah.
not actually really producing anything, even if, thousands of dollars are theoretically changing hands each hour.
Yeah, well, the assumption there, the rules of the game are that you're passing it back and forth by buying and selling things. So you can't just pass it back and forth because you want to pass it back and forth. The rules, the way the game works is that you use it to buy something. So somebody has to give you something that you value as much as that money
I
for
mean,
that.
we say that, but people are paying, ridiculous amounts of money for digital pictures,
Yeah,
for non-fungible tokens. So just
we'll,
like,
we'll, we'll, we'll we'll get there. We'll get there.
okay,
We'll get there. We'll get there, but let's not
All right,
complicate it
infinite
yet.
velocity money. Got it. Okay.
Right. So more money demand. The intuition I'm trying to develop here is that more desire for savings is more money demand, right? So if everybody in the economy is like super conservative and they're like, I need to save up like 5 years of expenses just in case, I get laid off and I can't find a job for 5 years. I'll still have enough money to spend, right?
Mhm.
So if they're super, conservative, and every single person in this economy is going to save up 5 years worth of expenses, then if you have a $20 trillion economy, you're going to need to have $100 trillion in money supply to run that economy on, because everybody's holding it, a huge bucket of 5 years worth of expenses. And so it comes into your savings. And like, if you think of it in terms of like turnover, it's going to be 5 years before it goes out again. So it's all, everybody's got 5 years. That's the money demand.
So cultures like India, where
Yeah.
people buy gold jewelry and things like that as savings, as for
Yeah.
assets, they
Yes.
have their money demand is larger or smaller?
Well, they will have a money demand for gold and then a different money demand for currency. Yeah. So, to the degree that maybe they like to put their savings in gold instead of currency, that would reduce their currency money demand. And it would also increase the money velocity by the same, by the same token.
It would increase the
Because,
money velocity if they were
yeah,
holding their assets in gold?
yeah, it would increase the money velocity of the currency. Because if they weren't putting it in gold and they were saving it in currency instead, then maybe they're building up like 3 years. I think India, like the people who buy the gold, I think it's sort of it is the sort of conservative type of thing that we're talking about, where like they just
Yeah,
want to have lots of savings and
right.
just feel really secure. Like, don't worry, I've got money.
Yes.
My family's never gonna starve. Um, if it wasn't gold and it was currency instead, then they would have this huge buffers, like everybody would have this money stored up somewhere. Um, and that would be lots of money demand, and it would be very low money velocities, because each item of money is not like circulating very fast. It's like going to somebody, and then he's gonna like put it into his storehouse, and it's gonna sit there for 5 years, right? So money velocity is really low if money demand is really high.
Okay.
Okay, that makes sense, right? So where are we going with this? So that's how you understand money demand. The money demand is essentially demand for savings. And the higher the demand for savings, the lower the velocity of the money. So to bring this around to type 2 inflation, let's do the standard capital consumption theory thing and say that to really understand what's going on in the economy, you got to understand that what happens at the top is different from what happens at the bottom. So at the bottom of the economy, bottom 80%, 50%, there are statistics, they've done surveys, like people don't save money. A lot of people are, living paycheck to paycheck. So, and they get paid every 2 weeks. So on average, like they start off with 2 weeks worth of expenses and then slowly goes down to zero before they get to the next paycheck. So on average, they've got like 1 week's worth of expenses in their savings. So 1 week worth of expenses is, there's 50 weeks in a year. That's a money velocity of 50. For the bottom, 80% or some portion of it, the money velocity is 50. The money demand is 1/50th. It's just 1 week worth of money demand. That's the bottom. On the top, it is much higher. It's much higher because if you look at the average money velocity in the US economy, I think it is like around 1 or 2. That's 1 or 2 times per year. And so if the bottom is at like around 50, then there must be something in the average at the top, which is, what's happening is that the, people who are wealthy, they have, lots and lots of savings. Like they may have, 10 years worth of expenses saved up. And so the two average together, you've got really high velocity at the bottom, really low money demand, and really high money demand and really low velocity at the top, if that makes sense. The people are at the bottom, it's not necessarily that they don't want savings, but this whole thing is a consequence of capital consumption imbalance, and you're having income concentrating at the top. So the people at the bottom, it's not that they wouldn't like to have savings, it's generally that they're like super strapped, and they just can't manage to save money. They just, they're just struggling to get by with the income that they have, and nothing gets saved. So that is the situation we're in. And I would argue that it is potentially puts you at risk for type 2 inflation. So the reason it puts you at risk for type 2 inflation is because this money concentrating at the top, it's a little bit excess, idle, and stagnant. So in a healthy economy, if consumers had enough income, then it would be profitable for business firms to invest in more capacity. And so that money at the top, what do capitalists do? They invest money. That's sort of why they're capitalists, because they're always investing and they're always making more and more money. So it's healthy for that money to go into real investment and increase capacity, create more production for everyone. But when you have capital consumption imbalance and the consumer doesn't actually have money to spend on things, that cannot happen. And so what happens is that, in the investment markets where you have, a factory is the ultimate demand, the ultimate place where capital should be going, but you're not really able to build as much factories. That's the demand. And so you have low demand and high supply of investment funds. And so what happens is that interest rates go down and something called discount rates go down. So discount rates are, discount rates are like when Warren Buffett goes to look at if he wants to buy a stock, he's going to compare the earnings of the stock to the earnings of like a treasury bond. So if the treasury bond earns like really little, then when he looks at the stock and says, how much is this worth? If the treasury bond earnings are little, then he would take the same expectation of, it doesn't have to earn very much. It just has to be like earn more than, the 1% or 2%, or even the negative 1% real yield that I get on treasury bonds. So, if real yields are negative 1% on a treasury, that makes stocks actually look like really good. Like, as long as the company's earning money, that's going to be more than a treasury bond, which, gives me like minus 1% and actually like loses money in real terms. So that makes asset prices go way, way up. Type 2 inflation is that at some point, and at the same time that this is happening, you also have like a lot of money demand, monetary savings concentrated at the top. Like it may be only like, say, it may be like 10 years, which is a lot, but it may actually not really be a huge portion of the wealthy person's portfolio. But anyways, it is accumulating at the top. And the risk is that the risk is that people, the wealthy who have all that money, at some point they lose faith in the currency and they figure, oh, the Fed's printing a lot or whatever reason, and they rush out. So I would like to compare this to a different narrative, which I think is incorrect. And the narrative is that, and I think this tends to come from people a little bit more on the right, is that, for example, if you look at a country like Argentina, that what is happening is that the government is going crazy printing money, and there's only limited supply. And so necessarily that causes prices to go up.
Why does it cause prices to go up?
Well, the narrative is that it causes prices to go up because there's only so much supply. Um, and so prices have to go up because the government printing money does not create more supply. It just sort of allocates or reallocates. And then if you print more money, then then each piece of money is like a smaller share of the, the limited supply. So prices have to go up. That's the narrative. I'm saying that it's incorrect, and I'm going to show you why it's incorrect. So the key piece here is that limited supply. So if the narrative is true, what you would expect to see is that as the government printed lots of money, capacity utilization would go up to like its limits, like it would get up to 95% or 100% or whatever, and then inflation would just start going crazy. That is, I think, if you put it turn it into a quantitative like model, this narrative, that's the narrative that we're talking about, right? Too much money, and then you hit the constraints of supply, which are the constraints of capacity, and then there's no way for it to work, and you can only get prices to go up. So I want to
Do you have charts or something of capacity utilization in Argentina?
yes.
Is that the
Yes.
problem? Oh, cool.
Yes, we're
All
going to
right.
go to the charts, and this is how economics should work. You've got hypotheses and theory at the top, and then you got to compare it to what actually happens and see if that works. So we're taking a hypothesis that I've told you, I've spoiled the result and told you that this hypothesis is not going to work, because the hypothesis says that you put in lots of money supply, you reach the limits of capacity. So you're going to see capacity utilization go up, and then you're going to see inflation. So that's what we're looking for. We're looking for this hypothesis says we get high capacity utilization, and then you get high inflation, because the government is just printing all this money into the economy. So I think most people know that. And let me share my screen here. That Argentina is a little bit famous for inflation. So this is 2012 to 2020. And 2012 was like relatively mild by their standards, 10%, to 2014, and then from 2014 to 2020 goes, there's some up and down volatility, but it's just keeps going up and up and up.
And Eddie, just for clarity, that's the annual inflation rate?
Yeah, that's annual inflation rate. Yeah, that's going up to 50% per year now.
So still a far cry from technical hyperinflation, which would be
so this is not hyperinflation.
Okay.
Which I think will be interesting. There's something interesting about that later. But again, the narrative that you hear that lots of people, completely believe, and it sounds like it makes sense, is that government prints lots of money into the economy, but they're not actually creating production. So, production gets maxed out, supply gets maxed out. And of course, you're going to have inflation because you can't have more supply. So our hypothesis here would be that capacity utilization would sort of, maybe it would like max out around 2014 or something, and it would probably just stay maxed out from 2014 to 2020. So let's take a look and see if that is true. And then I'm going to have to share capacity utilization. Yes. Okay. So again, 2012 to 2020 is what we're looking at. So here is capacity utilization, and it's at about 80% in 2012, and from 2012 to 2020, as inflation keeps going up and up and up, and our hypothesis is that inflation goes up because you're maxed at capacity, and you're putting more money into the economy, but you don't have that much supply, and that causes lots of inflation. Capacity utilization is not doing that. It is not, maxed out from 2012 to 2020. It actually keeps getting lower and lower.
I'm just curious. I mean, I don't know, what's the seasonal dip? Where it looks like from 2010 to 2016, it drops at the same time every year.
I'm not sure. Yeah, I've no idea.
Okay.
Yeah, but overall, I'm looking at, the hypothesis says we've got, too much money causing, supply to be maxed out, and that causes inflation, and this does not support that. Actually, capacity utilization keeps going down and down. You can actually have more. You can actually have more production here, but you don't at the same time that inflation is going up. So how do you explain that? I would say, of course, that type 2 inflation, and CCT explains that. What I would say is that here's something else that you have to know about Argentina. And gosh, I'm not sure if I have this on my desktop. So I guess I'll have to just look it up on Safari. Okay. So let's share Safari here. Safari. And I want to look at what is Argentina inequality, because CCT says that type 2 inflation actually occurs in conditions of high inequality and capacity consumption, capital consumption imbalance is what we were talking about a little bit back. So if you hopefully this will be useful. No, this wasn't the most useful one, but okay, I don't know if I'll be able to find it, just impromptu. But the point is that last time I looked it up, there's another thing that is very special about Argentina is that inequality is very high. And if you look at all of the other South American, countries which deal with high inflation, all of them have really high inequality. And which is really interesting because the right narrative of these countries is that they're like communist countries, and they do this silly communist thing and print lots of money, and give everybody lots of money, and so as a result you don't have enough supply, and basically you just get inflation instead of improving poverty. But if you consider what inequality is in these South American countries, it turns out that while the government may have a lot of sort of socialist rhetoric sometimes, bottom line, these are not actually communist countries. They have the highest inequality in the world.
Can you bring up the inflation chart again?
Yes, let's go back to the inflation chart. So let's see, share inflation. So what I'm going to, I don't know if you had a comment or a question, Brian.
Yeah, I guess what made it, jump in 2016 from looks like 15% up to 40%, back down to 25%. So what is causing that?
Yeah. Again, I don't think I can necessarily predict like from one year to another, like what's going to happen in a particular year. But I will propose that, in the long term, in terms of the largest, most powerful dynamic here, what's going on is that you have a country with a great deal of inequality. All the money is concentrated at the top, and you have capital consumption imbalance. The poor people, the bottom half of the population, they're actually not able to purchase very much stuff. And so when the wealthy capitalists, they've got all this capital, but they cannot actually build more factories. Like it would not be really, um, it would not be profitable to serve the bottom 50% with products from the factories because they don't have income. So they've just got all this money accumulated. It's a little bit stagnant. And what happens is that something may happen where they are worried about the value of the currency. And so what they'll do is they'll move out of their currency holdings, like they had 10 years, but then they start getting worried about the currency and they just sell all their currency. And they trade it for gold or other currencies. Nowadays, they may trade it for Bitcoin. But whatever they do, when that happens, they lose faith in the currency and and the money demand goes way down. They used to have 10 years, but they're like, I don't want 10 years anymore. I can do with just 1 year because, it's like, I think it's going to lose value in the meantime. When they do that, that is supply of the currency on the market, and it drives the market price down.
And so how does that translate into inflation? How does that make my groceries more expensive because the wealthy are buying houses?
Yeah, that is a really interesting question. And I think you've looked at, I have like a little article about hyperinflation, like tucked away somewhere on Medium. And I used to think that what happens is that when the wealthy let go of their supply, so their supply of currency on the market, like for instance, with Weimar Germany, you had this dynamic where the exchange rate went way down. And so foreigners got this currency very cheaply because the German capitalists were trying to get rid of it. So it goes into the foreigners' hand very cheaply, and then they, through tourism and through exports, they spend that money into the German economy. So I used to think that what happens is that there's like an unstable spike of consumption, and that maxes out capacity. So this is also like so this capacity utilization chart here is also sort of disproving that prior thinking of mine. There's no spike in capacity utilization with inflation. It actually has, it's not there. And so I would propose that there is a different thing that's happening, which is that one of the results of inflation fears is that businesses will actually raise their prices.
And this is what we're seeing in America right now, right? Is that businesses are reporting record profits or
Yeah,
but
yeah,
their
we're
profits have
seeing
gone way
that a little
up.
bit in America, and it's not a very good thing. And if you look at this capacity utilization here, what happens is that because a lot of people like get I think a little bit confused because they think of and I was confused. I had the same confusion because they think that prices can only go up when you have like lots of demand, overwhelming supply. But that's actually not true. Prices can actually go up. So how I would explain what's going on right now is, again, I would go back to, this is something that happens under high inequality, capital consumption imbalance. And what happens is that, and it's a little similar to something Alex Hallett talks about also, is that you end up with a demand curve which becomes very steep. Very steep, has it like this. Yeah, steep demand curve. In terms of, again, like the bottom 20%, there are the top 20% or 10% are like doing really well. They've got tons of money. So if you raise prices on them, they will, it's fine for them. They can afford it. But the bottom 80%, like if you get inequality high enough, then the people on the bottom for a lot of products, like they will not be able to afford the product regardless. Like even if you did not raise prices, they would still not be able to afford it. So as a result, the businesses, they are actually starting to find, and you hear that anecdotally from the business community, like Warren Buffett mentioned this, and somebody else mentioned it, and I can never remember the name, that businesses are finding that they can raise their prices. They're discovering this, and it does not hurt the quantity that they are selling. Like they can sell almost as much and raise the prices, and that's profitable. And I would suggest that that happens because of inequality. So the customers who can afford it, they can afford to, much higher prices. The people who cannot afford it can't afford it even at the current prices. So if you raise the prices, they were never buying your thing anyways.
So
And
let's
so your
say,
demand quantity does not actually go down.
so my store sells 100 widgets a month,
Yeah,
for $10 a piece.
yeah,
Um, or I buy 100 widgets a month, and
yeah,
I'm selling 90 of them, at
yeah,
$10 a piece. And I decide that inflation is coming, so I raise the price to $15 a piece.
yes.
And I still only sell 90, or I sell a few less.
And you're
Um,
surprised because your Econ 101 class told you that when you raise the price, like your quantity would go down.
right.
But you're surprised and you find that, it goes down like one. Like you raise the price. How much did you raise the price? 50%, 20%?
50%. Yeah,
50%.
sure.
So you expect that Econ 101 says it's going to go down like by like it's going to go down by 33% and you'll end up even. And you're surprised because you raise the price 50% and you find that instead of 90 widgets, you're selling like 80 widgets. So it's a little bit less, but your revenues just went way up. And then after you think about it, you look at the people who are buying the widgets and they're all like, like fairly well-to-do. They're, successful professionals or whatever. Like they've all got lots of money. So it turns out that you could have just that you can just raise that price and they can pay it and you'll get more revenues and more profits.
Shouldn't Econ 101 say that, like, I guess that I want to sell everything that I buy?
This is
Um,
this is micro econ 101,
that's
not
102,
macro.
103. Okay.
Well, I don't know.
I don't know. Never
The
mind.
high school micro econ, the high school economics says that you should want to maximize um, your profits and maybe your revenues. Um, but even you want to maximize your revenues, okay? But selling, so when you were selling 90, let's say you were selling 100 because the math is easier. You were selling 100 widgets for $100 each. So you're making 10,000 revenue. But then you're worried about inflation or whatever. And you decide, or you just, right. So then you raise your price up to 150 per widget. Okay. And you're surprised. You would think that you're kind of thinking that maybe, like you'll only be able to sell 67 widgets, which would balance that. So you'll still get just the same $100,000, revenue. But you're actually surprised that instead of going down to 67, like it only goes down to 90. And so now you're selling 90 widgets at $150, and your revenue is now up to uh, I think it's $135,000. You're making 35% more revenue for the service of jacking the price up 50%, and you make more revenue.
Okay. And in the meantime, the factory that is selling me the widgets, I'm
Yeah,
not buying as many now. So
yeah.
they lay off people and their capacity utilization rate falls because there's not as much demand at the higher price.
So your question is, yes, yes, exactly. That's what this chart is showing you. That the prices went up. The wealthy and the fairly well-to-do could continue to afford it. They're fine. The businesses are like, whoa, this is really profitable. But there's 10 people who don't get to have widgets because they were not that well-to-do. And capacity utilization goes down, and the factory finds that their utilization is going down. They're not selling as much widgets, but they may also raise their prices. Anecdotally, the factories are doing the same thing. Like they're finding, whoa, I only have 5% margin, but suddenly I suddenly discovered I was worried about inflation. I put the prices up 10%. I thought volume would go down. It did, but like just barely. Meanwhile, I've tripled my margins, and like this is really profitable to raise prices. And the reason that this happens again, this is not something that happens in a healthy economy. It happens in an economy with very strong inequality and very high capital consumption imbalance, where the money and the purchasing power and the income is concentrated at the top. And at some point, businesses, and it's also often because of a narrative of inflation, they find that it's actually more profitable to raise their prices. If you do not have the capital consumption imbalance, if you have a UBI in this economy, or you have less, or you have like social spending, like the democratic socialist countries, and you don't have that much inequality, then everybody is able to afford those widgets. But the bottom end, maybe just barely. So as a result, if you increase your prices, you will see a really big reduction in volume. And so businesses, when they try increasing the prices, they find, no, that's not profitable. I can sell it for 10% more, but then I lose 30% of my business. And that is less profitable. So it's better for me to actually keep prices low.
So it's because the markets aren't working properly in Argentina.
It's because the whole economy is not working properly, because there's too much inequality. Everything's concentrated at the top. And so as a result, basically businesses are incentivized to raise prices on the wealthy, because the wealthy have so much money that they don't know what to do with it, because they can't build more factories, and just ignore everyone who doesn't have money, because they don't have money to spend anyways. So even if I lower my prices a little bit, they still can't afford it. So the incentive for the business in terms of maximizing profit is just to raise prices. Even if capacity utilization goes down, it's still more profitable. And that's exactly the anecdote. And like when Buffett talked about it, he said the same thing, that these factories are not full out. They actually have lots of unused capacity, but they're finding that despite that, it's actually more, they can raise prices, and it's profitable.
So how do you deal with that?
You gotta send a UBI out. Very complicated understanding, very simple solution.
Yeah.
But
and the reason you're doing a UBI is to address inequality, sort of.
Yeah, because the economy does not work for the consumer when the consumer does not have money to spend. It's a it's like it sounds philosophical, but it is like literal, like when you analyze this entire dynamic, it's literally true. This is not a like political spiel, like, oh, we should do this and it sounds great and this is a good soundbite. It sounds like a soundbite. It's literally true. You need UBI. If you don't have UBI, you get this really warped, screwed up economy, and it's going to do all these funky things.
All right. So going back to Argentina, let's say that you instituted a UBI.
Yeah.
What level would you institute it at? Because you need to bring everybody up where they could pay the inflated prices?
Yeah. So, if we do a counterfactual and go back to 2010, I will say that there is another piece of this. And the other piece of this is that, and this happens also a lot of times in these high imbalance, high inequality countries, is that a lot of them are somehow not very good at taxing the wealthy. They don't bring in very much revenues, and instead of taxing the wealthy, they take the other option of borrowing from the wealthy, borrowing lots of money. And some people would say that government borrowing is not a problem, because the government can always print more money and pay off all the debts. I would say that is true, and that is exactly the problem, because it feeds into the narrative, and it also feeds into the dynamics where, when you let your government get super unbalanced in terms of not bringing enough revenue through taxation that it should be bringing in, and so it's dependent on borrowing, then what happens is that when the borrowers, the lenders, which is the wealthy, the people with capital, when they start worrying about your currency, and they start pulling out, yes, you can pay it back with you. Yes, you can do the whole thing. You can maintain your spending with currency, um, but as a result, you are on the hook for printing lots of currency if you want to keep your spending up. And this is occurring while people are pulling out of the currency. And that tends to drive the value of the currency down. Lots of supply through your printing, lots of supply through people who used to be holding your currency or holding bonds, which are promises of your currency. And now they're selling all that. They're selling their bonds, and then they're taking the currency they got for the bonds and they're selling that also. So part of the problem is the government getting into a a relatively unsustainable fiscal situation. And the way you fix that is you got to put taxes up. You got to send UBI out, and UBI actually helps also, because if you're actually doing more production, there's also more tax revenues. That helps. You also got to tax the wealthy more. Yeah.
Yeah.
And if you don't, you get those problems. And this, this narrative, this sounds a little bit like that right side narrative where it's like, oh, the government's being irresponsible, blah, blah, blah.
Well,
but
so
again,
the other way to look at it, though, would be that the money supply is increasing because the wealthy are liquidating their savings, and they're increasing the money supply by putting it in the market instead of holding it as savings.
Right.
Is that
we're being a little bit loose with the term money supply, and there's this is one of the things that you got to be careful about with money, is that there is a supply flow and then there's also a supply stock. You know what I'm saying?
Yeah. Okay.
So
good
they
point.
are, so yeah, they're putting a flow of supply on the market because they are reducing the stock of the money supply that they want, and they're getting rid of it. So that creates a flow onto the market. But I would even say it is a reduction in money demand. Like, they were the ones holding all that money, and then if they take on the narrative that they don't want to hold on to that money, then they get rid of it, and it's a little bit of a hot potato. It's got to go somewhere. But I wanted to say that, see, what I'm saying sounds a little bit like the right narrative, but I'm saying that it's different. It's the wrong conclusion. So the right are like, oh, the government is being very irresponsible, and I'm saying that the government is being very irresponsible not because they're being too socialist and doing too much spending. It's because they're actually being too, I don't know, it's because they're not being responsible because they're not bringing enough tax revenue from the wealthy. And if they brought in enough tax revenue from the wealthy, and if they put more money into the hands of consumers, that would actually be the responsible thing to do. It would build up the real economy, and it would fix everything. And I send my my hyperinflation article sometimes to people who lean right a little bit, and a lot of them send back the the obnoxious Leonardo DiCaprio, ha, 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 he just obnoxious replies like that. That's ridiculous. I can understand why they think that's ridiculous, but they think it's ridiculous because they're using a very simplified narrative that seems to make sense, but if you look at the data, it's wrong. It's simply not what's happening. Yeah. And so that's why, yeah, it's a UBI is a weird thing, because politically, for me, I think there's problems with what the left's thinking, there's problems with the right thinking. And if you think about it right, you realize you need UBI, but then you go to the right and the left, and and there's people arguing against it from both sides, for all these different reasons. So it's a bit of an interesting place to be.
Yeah. Eddie, with the capacity utilization chart, why didn't you make it a 10-year chart instead of a 20-year chart to match the inflation one?
I actually, let's see, I actually tried to get as large, as long of one as I could. And the reason I did that is that I wanted to have a one that went out farther is because this is not the first time, obviously, that Argentina has had this problem with inflation. So you've also got
I feel
1977 to 1980. So you have like it's like the third time I think that they've done it, that they've had that problem. And I think the episode's a bit too short to have for me to go through all of those in detail. But the basic stuff, but the basic stuff that I was looking at, um, the CCT, concept of why this happens, it matches up with the data for all of them. Like it
Okay.
happens because the wealthy, at different points in time, they start worrying about the currency, and they rush out, and also to some degree because um, you have the high inequality, and at different points in time when businesses are worrying about the inflation and they raise their prices, they find that it's actually profitable. So they keep doing that. And at the same time, the government is on this treadmill where they're sapped, they're, what do you call it? Um, they've got all this debt, and they are having to print lots of money trying to keep spending up. And they're not able to keep up. It's much easier to raise prices than it is to increase the money supply, and it's transparent. Like the businesses know the money supply is going up, and so they've got this great excuse to like keep raising prices, and they'll do that. It's easier for them to raise prices than it is for the government to print money.
So where's the money accumulating?
Um, the government is printing money, and the question is, where is the money accumulating? And so the main driver, obviously there's lots of stuff going on here, but one of the main things is what I just said. Like businesses raising prices is actually fairly easy. Like
Right.
in our hypothetical example, we just all we did is change 100 to 150, and suddenly
Right.
our revenues went
Okay.
way up.
And then,
So
so
what's
then what am
happening
I
is
doing
that
with that money?
that what's happening is that all of that money supply is actually being absorbed um, into higher prices. So you have money supply going way up, but you have prices going way up. And generally speaking, in type 2 inflation, the prices actually rise faster than the money supply. So it makes sense that capacity utilization goes down. So you get up this, ballooning money supply, but prices go faster. So the real money supply is actually going down. And your capacity actually goes down. It actually keeps getting lower. It's not that, spending goes off the hook. It's that prices go off the hook faster than money supply going off the hook. And people actually get poorer and poorer in real terms, and they cannot spend as much.
So,
Um,
so so if there's all this extra money being circulating, where
yeah.
is it accumulating?
Where is it ending up?
Yeah.
Remember, the money supply is like from our earliest thought experiment. It's well, here it's getting bigger, but the money supply, like in terms of in transactions, it's not created or destroyed. It just gets passed around. And
Or
I
maybe instead
guess
of
that
accumulating,
it's
where is it spending more time if the velocity is slowing?
I guess it actually ends up back in the hands of businesses to some degree. Like, yeah, um, yeah, because they raise their prices, the profits go up. It doesn't during type 2 inflation. A lot of times, like people with no savings, people who sell their labor, like their wages also go up. And so like it is sort of hard times around for everyone, but it's particularly hard for people who have a lot of savings or like fixed income retirees. Like they get, super screwed.
Yeah.
Laborers, usually their wages more or less keep up because the businesses, but I guess probably not completely, they probably get a little bit down because remember, capacity utilization is going down. But you just end up with it stays back in the hands of the wealthy, really. It goes back in the hands of the wealthy.
And so would a value added tax, as a business tax, that would,
That would be good.
help,
Yeah,
that would
absolutely.
help, so
Absolutely,
as,
because Amazon pays almost no money to the government because technically they don't make any profits. They just have inflated, they have just have, their value goes up, but they don't make profits. Um, they keep their net margins very, very low and just try to keep growing the company.
yeah,
Which is not a
like they,
terrible
they,
thing, but they should pay some taxes. Yeah. They just pay their taxes. It'd be good.
yeah,
I don't know.
that's about an
How are we
hour, right?
on?
That's probably
About an hour?
yeah.
Okay. Any other questions or comments, or shall we say,
I think I'm good.
okay. Well, thanks everybody for
Interesting
listening.
topic though, Eddie.
Yeah, hope this was an interesting episode. See you guys in 2 more weeks. Capital consumption theory, Eddie and Brian. Talk to you guys later.